to see you all. It's great to see some familiar faces in here. For the first time that we're doing this as a webinar, it's kind of ironic that it's probably the time that we really should be having those complimentary glasses of wine on the side. So my apologies that we're not able to do that. Hopefully we'll be able to all do it soon. And most importantly, I hope that all of you and your families are safe and tucked away in your homes, and that this is more just a conversation about the economy and something to keep you interested. They're really starting to flow in now, so sorry for the distraction there. We're going to cover several topics. Most of this is going to be more of a historical background on what's going on, i.e., it's not supposed to be a news recap. It's the general economy and how we're relating it to things of the past. So naturally, we're going to start off with the elephant in the room, which is the COVID-19 situation. Now, I don't have to debrief you on everything that's going on. It's how we're interpreting this on the general economic side. And on the general economic side, how we're interpreting it is the number of cases. Now, essentially, you've seen this graph in some of the past emails that we've sent out. And it's a wonderful graph because it shows the number of new cases on a logarithmic basis to where we can really see when those cases fall off that exponential growth. And that's what everybody is after, is falling off that exponential growth. Now, we see that there's only a handful of countries that have actually done so successfully. China, South Korea, Australia, Hong Kong. A lot of these are more rural or smaller city states apart from China, which we won't even get into the relevance of those numbers of how significant they might be. But you can see all the developed countries are up in the upper right, the United States, United Kingdom, and all the European countries. And that's what we're hoping for, is the proof that it continues to fall down as we continue to have these lockdowns. That's how we will know that we're moving forward in this situation. And that's what we're aiming for. You'll see these links in the follow-up email after this that will show you how to get to this graph that's updated once a week. But that's the one that we're really using instead of just the straight WHO numbers, because we really care about it falling off that exponential growth. There we go. Okay, so what are we looking into? We're really looking into the back history. You're hearing a lot of people say that this is an unprecedented event, but it really isn't. We've had plenty of pandemics in the past. You know, the most historic ones were the plague back in 1331, SARS in 2003, 2015 with Ebola, and 2010 with the swine flu. We're really going to be concentrating on two major ones because they have the most prevalence when we're talking about the general economy. Those two are going to be the Spanish flu, because the Spanish flu essentially gives us the worst case scenario. Why was the Spanish flu so bad? It not only impacted a good portion of the world, 500 million people, killed 50 million people, but it lasted 2 years and 3 months. So it really destabilized the overall economy. And the time that it takes to get to recovery is the most important factor in this whole thing. That is what we really care about when we're talking about how it's going to affect our stock portfolios. So when we're comparing the Spanish flu, that's the timing frame that we care about. When we're comparing it to the 2003 SARS epidemic in China, essentially, we're really looking at how Chinese companies reacted and changed to cope with it. And that is how we're trying to structure ways to rebalance our portfolio instead of just panicking and moving forward. There are going to be winners and losers in this, and that's the really sad effect. All of us are in developed countries, and as bad as it is, we still have relatively low death levels in comparison to what they were projected to be we still only have 2 to 3% of the world's population that is possibly infected, according to the WHO as of this morning. Where we're really going to see the problems is really in the emerging markets. Emerging markets are always the hardest hit in every single pandemic because they spend the least amount. India, for example, spends $6 per citizen when it comes to healthcare. To put that in comparison, the United States spends $6,000 per citizen. So the difference of what they're spending is one of the major factors, but it's also the fact that most people are living hand to mouth in those countries. We had a big article this weekend from the Financial Times that was really breaking down that Malaysia and India are going to be two of the hardest hit countries when it comes to starvation after the pandemic. So people are having to decide whether they want to eat or whether they want to keep themselves safe from coronavirus. Governments will come into place to help on those types of factors, but it doesn't help universally. That is to where when we look back to the Spanish flu, the 50 million people that died during the Spanish flu, 18 million of them were in India alone. And we hope that we're wrong on this, but the expectation would be that the same thing would repeat because of those resonating factors, i.e. the investments in healthcare infrastructure and the ability for people to hunker down and be able to outlast this pandemic. Essentially, why are some countries taking different views on restrictions? I think this is a very important factor because Brazil, the US, and partially the UK are a little bit more laissez-faire. The Danish, the Swedish, and the Spanish seem to be letting things start to get back to normal at this point in time, and a lot of other countries are on pure lockdown. Well, there is the economic versus the healthcare issue, but the longer we stay in lockdown, the more likely we can have other issues. So essentially, what we have are the different forms of death percentage increases based on a 3% increase in unemployment on the left, which is going to be something that becomes very significant because in the last 4 weeks, we've seen 22 million people file for jobless claims in the United States. So all of a sudden, we could be looking at new issues that come about from being under lockdown. Now that's just the unemployment factor of the whole issue that you're going to hear a lot more talk about, and you're going to hear a lot more politicians start to push in that way to let people release and let companies try to get back. That comes back to the history, though. When we go back to the plague, Spanish flu, all of these epidemics, all of the pandemics, the societies that stay under lockdown the longest recover the fastest because they don't have the number of deaths. Now, we always say that in economics, we should never think this time is different. This time it might be a little bit different because naturally those situations were more deadly to the working class rather than the elderly class. And the working class was the engine of society. Nowadays, that's mostly true, but not to the same level as it was back then. Now, the other part is the psychological effect of a pandemic. One of our clients, one of our friends, brought up a great analogy of what is the difference between a hostage situation and somebody being in prison. Now, a person in prison is basically counting the days down till they get out, whereas a hostage is actually counting the days up because they don't know if they're ever going to get out. And we're still in this hostage situation at this point in time, dreaming of the day that we'll just be prisoners and we can count down the days until we get out of lockdown. Now, this is a huge psychological dilemma because in a hostage situation, you have more people that end up with PTSD. This is what we ended up with in the SARS epidemic. And you can lead people towards having Stockholm syndrome, i.e., essentially getting attached to that being their new normal. That is something that we really hope that our societies can stay away from, and why it's so important for us to get closer to a prisoner situation, getting down to a countdown of the days until we get closer to normal. And that is really what we're looking for in what's coming up next, right? Now, if we look at it, we know that we have this curve from China of how long it took them to get out. And that's where we would expect to be on something close to that curve. We're starting to see a semblance. Remember the chart that we showed you, the logarithmic chart showing that decline in the number of cases in most European countries. But we still haven't seen the full reversal like we have in Australia or Hong Kong and the such. And that's to where we're really hoping that we're going to see that in the next week or two before the end of the month, so that we can go into summer with some hope of getting back to normal or more businesses getting back in line. That all being said, the US has really taken over as the epicenter. And that is very disturbing to us for a couple reasons. Now, first of all, because essentially that is a large affluent society that 57% of the world's market cap is driven by, but also because those individuals have a 4 times higher retirement pot that they're all sitting on, and they have their finger on top of the button. In other words, we have $5 trillion of retirement assets here in Europe that essentially you get a few choices of what you can put in your retirement account. In the States, they have $19 trillion worth of retirement assets. And with those $19 trillion of retirement assets, they get to select exactly what investments they'd like to hold and whether they want to sell out of them. So when a pandemic starts to hit home, we would be nervous that people will just go ahead and slam on the brakes and sell out of their portfolios, whether it's rational or not. And we will go through a little bit more on that timeline, but that is to where, economically speaking, the USA taking over as the epicenter of this situation is so disturbing. China is starting to come back online. And I know there's a lot of reports that basically say we shouldn't trust any of this, it's China, et cetera, et cetera. I know years ago we found this Federal Reserve piece that the summation of it was, we know we can't trust the numbers in China, but they are lying at the same statistical level that they have over the last 30 years. So we know that this is in line with that report. Now, it's a little bit to that certain level, but we trust, but we verify. And how do we verify that the numbers are coming back online in China? Well, first they were talking about the electrical grid. How much electricity were they consuming? But then they found that a lot of the factories were just running on empty. And therefore, a Chinese factory was taking up the electricity, but they weren't actually putting anything together. Now the better formation of how much of China is back online is the pollution level. Today being Earth Day, I'm happy to say that Europe, the United States, is at some of the lowest pollution levels that we have been at in recent history. China is going back to their normal, which means that they're coming back online. So the good news is they're getting into recovery, but we've had a 6% year-over-year drop in GDP for them. So it's going to have a big global impact. The rest of the world, we're talking about 8 to 10% in certain developed economies like Europe and the United States. So that's the bad news. The good news is basically all hands are on deck when it comes to the healthcare companies coming to the rescue and finding some form of treatment for this. Right now, the big headline leader is Gilead by far. Novartis has a great product as well that they're hopefully going to go through testing. But these are just the headline grabbers, because there are currently 267 different companies that have potential treatments according to Forbes. This doesn't even include the more disturbing one that you might read in The Economist this week that's coming out of Iran. And I'll let you guys figure that one out if you want to. Otherwise, I'll text you on the side. So all hands are on deck for this, but to get that actual product out in circulation will most likely take more than a year, closer to 2 years. And that's if everything falls into place. So this is not going to be a short-term problem that's solved just because we get into summer or just because we find the miraculous drug. We still have to find a way to distribute it. And that's to where healthcare stocks are something that's all the talk, all the rage, and a lot of the government funding, which is going to be important for the long term. And then we're getting some good signs that the exponential growth is falling apart, but we need to continue to confirm that as the Danish and the Spanish start to loosen some of their lockdowns. We have to see if that actually works or if we just go back onto that exponential growth platform. Now, a lot of people are talking about this being just like 2008. And in certain regards, they're completely correct. In certain regards, it's completely correct that it's the exact same thing as 1929. It is a credit crisis at the end of the day. The banks are all going to have a hard time financing this, just like 2008 and 1929. The key difference was that 1929 and 2008 were all built on greed and fraud. And this is not fraud. This is a freezing of the general economy. And that's to where the government reaction to this has been completely different from 2008 and 1929. Basically, right at the get-go, all of the governments have come in unison to support this and to fund it. We've gotten to date $7.5 trillion worth of stimulus, which is actually more than the GDP that we've lost at this point in time. So that tells you how much has been thrown at it. That doesn't mean that we're not going to lose more GDP. We'll definitely go over that figure, but we're going to get more funding going forward, and that's going to be the important part. Everybody's going to go ahead and help this out. Think of 2008, the banks were the bad guys. Today, the banks are our saviors. Essentially, all the funding is going through the banks at this point in time. And therefore, you have institutions like JP Morgan that are saying the banks are going to be doing very well financially going forward because they'll have all these loans that they'll be able to administer going forward. So then we get into earnings. Well, companies are naturally getting hit hard by this. Even some of the obvious companies like grocery stores, Tesco's here in the United Kingdom announced that even though their sales are up so significantly because of new hires, because of having to pay higher wages, which historically has always happened in every pandemic, and because of new costs associated with the pandemic, it's not going to lead to any extra profitability. But most other companies have a complete slowdown, whether it be hotels, cruise lines. The last cruise line actually just hit dock in Italy, of all places, on Monday. So there are officially no cruises going around the world right now, or going anywhere in the world right now. So that's led to a complete slowdown. On the left, you see the quick recovery if we took earnings of all US companies, ex-financials, after the financial crisis. You can see, led to a quick recovery. This one's going to be different. This one's going to be a little bit slower of a recovery. As you can see, the consensus estimates don't get us back to where we were in 2019 until 2022. Simply put, pandemics don't recover as fast as wars and other scenarios. The reason why? People don't spend as much after pandemics. People are not excited after pandemics. So it takes longer to get that momentum back and moving. When it came to earnings, we had 11 great years after the financial crisis of record earnings. On the left, you see that essentially nearly every single quarter, bar one in 2011, when we had the European financial crisis, companies were beating their estimates. And yet, the beginning of 2020, we've had the exact opposite, where you can see over on the right, the consensus earnings projections, which, let's be honest, mean absolutely nothing. Consensus has just dropped like a knife. We would expect that, and we'll expect a little bit slower of a recovery on those earnings. That being said, our concentration is not on what the stock market's going to do going forward. A little bit of that's a guessing game. We're cleaning up certain factors of that, which I'll get to at the end of this presentation. The big money by the end of this pandemic is really going to be made in the currency markets. The currency markets are ever so important as everybody's printing money. When people are printing money, that's going to shoot currencies up and down. We'll go back to a little bit of an Econ 101 example. I know most of you have heard this before, but it's always a good refresher. When it comes to purchasing power parity, The Economist put together a nice satirical way of explaining it. It's a little bit more fun than trying to analyze the prices of everything around the world. Now, they started it in 1986, and it's actually come to be a good, solid metrics of how we view the pricing of currencies around the world. Essentially, they take what the average Big Mac would be in any country. This doesn't include certain countries that don't have McDonald's. In those countries, they either use the KFC index, and in other countries, they actually use the Starbucks index, because it's a slew of different ingredients that you're just comparing the pricing model. Now, what we're trying to do is we're trying to just compare one against the other. And as you'll notice, not surprisingly, one of the most expensive places is Switzerland, and then you have the United States all the way down. Well, essentially, this is really important because it tells us where the flight to safety is on currencies. And let's back up and we'll kind of look at the last 10 years of where we've kind of evolved. It used to be that we had 7 great strong currencies. We had Australia, Canada, US, UK, Switzerland, Sweden, and Norway. We had a commodity shock back in 2014 that you'll remember. And so Australia and Canada, being heavily commoditized countries, i.e. their currencies are driven by commodities, fell off that list of strong currencies. We naturally had Brexit, and that slammed the pound down to low levels for the decade, and we were left with the 4 that we're sitting on today. Now, I'll actually stay back here for a second. When we think of those 4, yes, we have 4 strong currencies, but as people go for a flight to safety, there's only so much you can buy in Sweden and Norway. Norway, naturally, we think of it as being driven by oil prices, but because they have this big sovereign wealth fund that gets them diversified around the world, they don't bobble as much as an Australia or Canada would, or most definitely not any emerging countries. So that's why they're solid, but there's not so much to invest in there. Same thing with Switzerland. You're buying a strong currency, but what are we actually buying? We're just buying that currency. So naturally, when we have these scares, everything flies to the dollar. Why is the dollar the reserve currency, or the epicenter, the important currency of the world? Well, it's 2 things that came about after World War II. First thing is that it's the most used exchange currency. Essentially, most reserves will use dollars as their reserves. You go down to South American, African countries, many Asian countries, their reserves will fully be in dollars of what they can't buy in gold or other reserve currencies. You can see the split on your screen of the euro increasing significantly to 20%. A lot of that's the China effect of trying to get to a basket of currencies instead of just leaving it on the dollar. But the pound keeps going down. The Japanese yen keeps going down of the percentage of that currency that's used in reserve. And that's one of those big effects that keeps the dollar really strong. The second reason is because of what's called the petrodollar. Now, it doesn't just include oil, but oil, until 2 days ago, was the most important of those commodities. It includes most every commodity is still traded in dollar terms, meaning any of those developing countries that are selling oil will sell it into dollars and will have large dollar reserves on their books for long periods of time, which most likely means that they're buying US treasuries or other securities, propping up the dollar, keeping it at a stronger level. Now, both of these issues are things that will dissipate over the course of time. But it allows the United States to hold a record amount of debt. In January, you might remember that I wrote about my biggest fear for the year was that we hit a record amount of debt globally. Now, this isn't just government debt. This is government debt, individuals' debt, and corporations' debt, all put together, came out to $184 trillion globally. And nearly a third of that is just the United States debt. So having a strong currency allows you to leverage. If you go to usdebtclock.com, you can break down all the different levels of student loan debt versus credit card debt, et cetera, and you'll see that that debt comes out to about $70 trillion in total. If they don't have that strong currency, they can't have that level of debt. But you essentially have a big player coming along that's still sitting on a lot of US dollar reserves. They're still trading most commodities. They're the biggest commodity purchaser in the world, and they're still purchasing those commodities in dollars. But as they build new relationships, one day that will change. They've gotten into all the most important business lines. Like I said, they are the biggest commodity purchaser in the world because they're in these target sectors. And they've put together the Belt and Road Initiative, which is getting them to be trading all across Africa, buying all those commodities, and building relationships as deep as the European Union with backing of projects in Italy and Hungary. So this is not just an emerging world versus developed world function. This is seeping all over the place. Now, we know that this will eventually happen, that essentially the Chinese will let the renminbi free float. The question is when. Now, we have two variables that we're keeping a good eye on. I only put one up on the screen. The other variable, which we've been talking about for years, is essentially the percentage of the economy that is service sector versus manufacturing. In most developed countries, it's around 85%. China currently is around 68, 69%. So we've factored that once they no longer need low prices for manufacturing to stimulate their economy, and when they're a service economy, they'll want to have essentially a rich currency instead of a poor currency that won't devalue anymore. Now, that goes out the window a little bit because right now they have the opportunity, and there's basically two factions right now. One is that the dollar is going to become the richest currency in the world because of this pandemic, and therefore that flight to safety becomes advantageous. The other school of thought is that this will be the Chinese's opportunity to take over as the world's currency. We're not picking a side. I'm representing the stories of both sides. For right now, naturally, the dollar is that safe haven. But to me, the key identifier to see if this switches is naturally going to be the amount of US debt and how they're able to handle it, and essentially the amount of reserves that the Chinese continued to hold. You can see that since 2010, the Chinese have actually gotten rid of more reserves instead of building them up, i.e., they're no longer trying to push their currency down as much as they were. Now, that chart shows you all of their foreign currencies. And part of those are in pounds, part of those are in euros. They don't give us exact figures, but rough estimates are that we've dropped down to closer to $1 trillion of those 3 trillion in Chinese reserves being US dollar based. The lower that goes, the closer we are to a free flowing currency. At that point in time, all they have to do is open up the Chinese equity markets and investment markets to foreigners, and we will see the renminbi climb, and it will become a much stronger currency. This has become the big risk of this pandemic. We're not predicting it, we're keeping a good close eye on it. And that's to where you're going to see much more influence in the portfolios if this moves forward in that direction, to have some shifts into China. The good news is a lot of that can come from good sized US companies. And even in this week, for instance, Starbucks, who have 43,000 chains in China, just announced a contract to sell Beyond Meat burgers in every single one of their institutions. 2 American companies, Chinese influence, Chinese exposure. So big opportunities without having to have a full portfolio of names that you might not even be able to pronounce, let alone tell me what they are investing in. So that's the story on currencies and why it's going to be at the epicenter of all of our conversations and all of our allocation shifts. But there's more going on. You guys might have noticed that on Monday and Tuesday, we went into a historic time, something that's never happened before, which is that oil prices went negative. So literally, if you had oil, you had to pay somebody to take it off you. Now, several reasons for this. The historic reasons of the beginning of the drop of the oil prices was because of a quabble between Russia and Saudi Arabia. Naturally, the demand for oil has dropped through the floor. Planes aren't flying, cars aren't driving, factories aren't moving. The demand for oil has basically disappeared. And yet the excess oil, it's not like turning off your faucet that essentially you can stop the oil from flowing. It takes some time. And so the excess was going into storage. The main epicenter of that storage is in Cushing, Oklahoma, which is pretty much full. Most of these contracts are traded in Chicago on the Chicago Commodities Exchange, and they trade them in futures contracts. Well, most of these guys in suits and ties, they don't really want to own this oil. If you go to Chicago and you meet a commodities trader, you will probably meet one of their angry wives that have a story about them taking delivery of a ton of coffee or something of the sort. Now, you can't do that with oil because you can't just store oil in your garage or in a warehouse. You have to have it protected in certain ways. And therefore, everybody was desperate to get out of these contracts on Monday before they had to take delivery for them. And they were willing to pay people to take them off their hands. So these are historic times in that way. Some of that will correct just because they'll stop producing as much oil. The other portion won't be able to correct itself until most societies start to get back online and we start using oil, i.e. a great problem to have on Earth Day, but how does it affect the overall marketplace? Well, there's 2 sides of it. From a consumer vantage point, well, we should be happy. Oil is not included in most inflation indicators because oil drives the price of everything else with a 6-month lag. So when we're looking at that from a 6-month lag, we would expect prices to decrease instead of increase. Well, going back to the beginning of the year, I was nervous about inflation. Sign that we're not going to get inflation, having negative oil prices. From the other vantage point, well, a lot of us own oil stocks. Well, we have made a big move towards ESG, which means essentially those ESG portfolios, this would be DSI instead of the S&P 500 and the such. A lot of these are going to exclude oil, so it's not in our portfolio. But even for the people that don't have ESG portfolios, and therefore you have some exposure to energy stocks, let's put it in context. If we take every single energy stock in the United States and you add up their market caps, the market cap of all those companies combined is only worth half of the value of Amazon. And it doesn't matter if you use any Amazon or any of the FANGs, Facebook, Amazon, Apple, Netflix, Google, they're only worth about half that value. So it's actually a small part of the US, whereas Exxon used to be the biggest company in the world. Now it's nowhere close because technology has really taken place. Where it will hurt things unless the government gets involved is the fixed income market, i.e. bonds. These companies, it's not that they're not large companies, they're just mostly driven on debt. Exxon has been taking on excess debt every single year to continue paying their dividends because they factored the oil prices were going to go back up to that level of $140. So essentially, this could be a little destabilizing in the debt markets, but we wouldn't expect it to hit the equity markets as much as it would have 10 or 20 years ago. Now, the other commodity that, well, it's been a lot in the news, and I've spent a 20-year career basically going on the Warren Buffett mantra that you could take all the gold in the world and it would build a 67-foot building in each direction, 67 feet tall, 65 feet wide on each direction. And this is an old figure from 2010. It's an old quote of his that for the same value of all that gold, you could have all the farmland in the United States, you could have all of ExxonMobil, and $1 trillion to spare. Now the gold doesn't produce anything. You have to pay somebody to guard it and keep it safe. And all the rest create an income. I've always been of this mentality that gold is something that's worthless because yes, it grows by inflation. Actually, it doesn't. It grows by less than inflation and grows less than what typical interest rates are on 10-year bonds. Now, this has changed as well. Every Federal Reserve, every single central bank has pretty much decreased interest rates, and most developed markets are now either at zero or negative rates, which means that the old view of having gold in a portfolio, you have something that doesn't yield you anything, you can at least put it in a government bond and earn a yield, has gone out the window. Gold doesn't yield you anything, you pay small fees to have something in there, which means that it's actually not losing you as much as a government bond. That's what's really changed in this entire equation. And gold, well, when we started purchasing it last August, we were looking at it as a hedge to the over leverage in the global economies. Its growth has really come from that, i.e., our view on gold is it's a hedge on those currencies that I was talking about earlier, not so much the stock market. So we've seen a climb on gold. We hoped that that was going to be wrong in August as a hedge against our equity portfolios. Now it's going to become our true view of when we've hit bottom on the market, i.e., when we feel that we've hit total rock bottom on the stock market and we're coming out of this pandemic, that's the profit that we're going to take, and we're going to shift that over into the equities market. So I haven't converted into a gold lover, I just see that the situation is different because of the negative yields on government bonds. That being said, just this morning, Bank of America, it was for the last couple of weeks that Goldman Sachs was the most bullish on gold with a $2,000 price target. Now, my team can vouch for this. Our investment committee basically stated that we were looking at about an $1,800 per ounce exit point for gold. That was where we were factoring that it would be fully valued and we wouldn't be able to get any more value from it. Now, this is starting to really change as all these governments are printing more money. Bank of America this morning came out with essentially a $3,000 price target on gold. I think that is overly optimistic. I think that they're just trying to get a little bit of free press by scaremongering some, but it does tell you how much has changed in a short period of time when it comes to decorrelated assets. And if you invert this chart, my first impression, by the way, Cam was the one that built all these slides, so you can thank him for a job well done on them. But this one can be kind of confusing because what you're really looking at is an inverted view of what gold prices are. So it's flipped upside down so that it shows you what real yield values on the 10-year bond are in correlation to it. So essentially, when the gold value is going down there, it's really going up in value at the same time as those interest rates. And that's why we're saying that the only reason that gold is really increasing is because interest rates are declining so significantly. So what kind of recovery are we looking for? Well, there are four main types of recoveries. A V shape, a U shape, a swoosh, or a square root. We also have bathtubs, we have L's, we have all these different types. But we didn't want to fill up the entire page with different types of recoveries. We'll start off with kind of the basic principle. The V-shaped recovery is essentially we have a huge drop off and we recover very quickly. Think of the stock market, not this past December, but the December before. We dropped. Essentially, once the news subsided, we recovered very quickly and we kept running. That is a V-shaped recovery. Now, at the beginning of the pandemic, we were hoping that this was going to be a short-term lockdown and jobs wouldn't be lost in significant numbers and we'd get to a quick recovery. That is obviously not the place that we're in any longer, but I will tell you right now, if we go into a V-shaped recovery, I will show up to each one of your houses with a bottle of champagne and we will celebrate to no end because we will be lucky if we can get that. Now, an L shape is basically what happened to Japan in the 80s. Essentially, you have a huge drop off and you don't have a recovery, right? So they're still not at the levels that they were at back in the 80s because of over leverage. So that is the scary part if we were to go into a long-term issue. We're not expecting that at this point in time. It's a very far-fetched reality because there is the expectation of getting back to normality. It's the time that's the variable that can't be answered. So then it turns into the U or the swoosh or the bathtub, i.e. you have a general slowdown in the overall economy and it takes longer to recover because the general economy is slowed down. Now that's what comes about when you have mass unemployment and why every single government is trying to do their best at keeping companies from laying off so many people. That inevitably has not worked, as we can see from what's happened in the United States. It's inevitably going to hurt in Europe, the United Kingdom, and everywhere else along the world. So we have to brace ourselves for more of a U. Like I said, I would love to be wrong about this, just like I loved being wrong. I would have loved to have been wrong on the gold prediction last summer, but got to call a spade a spade. So how can this affect our portfolio? We've already seen some changes in your portfolios that we've made. We've already talked to many of you about it. And by no surprise, the top performers on the stock market are number one, healthcare, number two, technology, number three, consumer staples. Healthcare stocks, just like we said, 267 companies coming up with new potential cures for the coronavirus. That being said, there's a lot of government backstops that are going in. We only have 4 major companies that could actually distribute these types of products, and they're asking for the backstops from the governments, and the governments don't have the means to say no. The amount of R&D spending is going to increase going forward because of this pandemic, and inevitably that was one of the places that they had cut. So long-term healthcare stocks overall are going to be in a better position, even though R&D takes 20 years to develop. Technology is naturally and obvious. Yesterday, Netflix came out with their earnings, and Reed Hastings came out with a trifecta of reasons why they had much better earnings than they expected. They had 15 million new subscribers instead of an expectation of 8 million. So a lot more people dialing in. They can't buy any new content. The actors can't get down to the studios. They're under social isolation. So they're not paying for anything new, but they're selling more of it. And a strong dollar, when they're investing more, i.e. most of these new subscribers are coming from abroad, but that's mostly coming from investment abroad. So it's costing them less for that continued expansion. The US is pretty much saturated for them. So companies like Netflix doing wonderfully, but a lot of you have seen additions of Amazon in your portfolio. 175,000 new employees just in the last month. And they still can't meet the demand that's out there. With all shops that are closed, this is really one of the big plays to be able to buy things. I still can't buy any groceries from Amazon at this point in time because they only have the next 20 or 30 days online, and they're still not listed, i.e. There's still more demand than there is supply from Amazon. And we're just going back to the 2003 SARS epidemic in China. In China, what ended up happening was JD and Alibaba were infant companies. They grew astronomically and have only continued to grow at a faster pace in China, i.e. when you talk about e-commerce in China versus developed economies, they're a tenfold increase to what we are in developed economies. And we'll be playing catch up, Amazon being one of the big winners in that scenario. Companies like HelloFresh that deliver groceries or prepackaged meals, another one that we've started adding into our portfolio. But any of these technology companies, which make up 25% of the S&P 500, most of them are still in the growth trajectory when it comes to their earnings. Consumer staples, companies like Clorox, Procter & Gamble, Unilever, selling those staple products that you'll still need whether we're going into a recession or not. Those are naturally doing better. Think of the toilet paper shortages. Naturally, the worst performers, consumer discretionaries. Think of hotels, cruise lines, airlines and the such, financials, and the energy sector for what we just talked about. So what are we trying to do with the portfolio? We're trying to clean up certain parts. I'm not trying to change the allocation, i.e. the percentage of stocks to bonds, because with so much government stimulus, with $7.5 trillion worth of stimulus, it's basically like playing a poker game when you have the least amount of chips and you're trying to bet against the house. Essentially, the government can change who the winners and losers are going to be very, very quickly. But who do we not want to be owning? Well, the companies that might go bankrupt. And the companies that might go bankrupt are the heaviest leveraged companies. Some of you have seen us getting out of real estate investment trusts. So REITs naturally will have a hard time because they have heavy leverage. And as we get more bankruptcies, essentially, they're going to lose some of their customers in the near term. You're seeing us getting out of any of those heavily leveraged companies and oil companies and shifting them mostly into the technology sector, but you will see some plays in those consumer staples and healthcare. Home is where the fangs are. Facebook, Apple, Amazon, Netflix, Google. This is expanded even beyond that to the BATs, which are the Chinese equivalents, Baidu, Alibaba, and Tencent. And even beyond that in the tech plays, they have by far weathered this storm. Their earnings are going to weather this storm. So that is one basis that their products are going to continue to grow. The other basis is the cash on hand instead of debt. Apple is sitting on $220 billion of cash. When you're sitting on $220 billion of cash, you don't have to worry about not selling enough iPhones this quarter because of supply chain disruptions over in China. We know that we've seen Foxtron firing off people because they don't have enough demand for iPhones, but they have enough cash to withstand this, and more of their model has moved over to that service model, i.e. when you buy an app on the App Store, 30% in that first year goes directly to Apple. In subsequent years, 10%. They're living on that money. They don't care if you get a new iPhone or not, because if you don't get one this year, you might get one next year or the year after. I'll leave you on the story of Winston Churchill. We're all going through this together. Churchill essentially was a man of his daily tasks. We've all heard the stories of his daily baths, his daily naps, and his reading and writing regimen being like no other. And this really got him through the 10 years after being made the scapegoat in the Battle of Gallipoli during World War I. And that really got him to become the prime minister that he was. So I would say this is really the preparation for battle, the next real piece to life, and that we should all be using Churchill as an example instead of just putting our feet up and watching Netflix all day, although I will take suggestions for some of those Netflix shows. We know that we haven't hit the worst of it. The economy is going to go into recession. We're not technically in recession now. We haven't had 2 negative quarters, but I don't think you'll find an economist that doesn't feel that we will go into recession. The real question is how long and where it will take us to get out of this. I'm gonna pass this back over to Cam, and we can take any questions that you might have at this point in time.
Yep, thank you very much for that presentation, Brian. I think you've earned yourself a well-deserved drink after that long marathon. And thank you, ladies and gentlemen, for attending our first economic update of the year. We will now be ending the meeting, but if you would like to stick around for some small talk, you're more than welcome. If you have any questions or you would like to get in touch, please feel free to email us on the links provided on your screens. Or alternatively, feel free to book an appointment, and we will be sending the links out. Additionally, we'll be sending out a follow-up email, which should have the recording of the webinar and the slide deck, so you can review that further in detail in your own time. But other than that, I think that's a job well done. So have a wonderful rest of the day, ladies and gents.